Hey traders, John Howell here from tradinginvestingforyou.com. Anything I just say in this video is general advice only, and it really is general advice because this is about educating, it's not about advising you. I'm really here to help you understand what's happening in the markets, give you tools, techniques, and basically formations and strategies and targets and so on and so forth to really help you move forward while understanding how to read this chart, which in turn should help you to become a better trader. In this video, I'm not going to be going over a market. I'm actually going to show you a technique of when this happens, how to actually get a projection out of a certain pattern. And that certain pattern is known as the flag formation. Okay, the flag formation. So let me just delete these trend lines here, and I'm going to zoom in on this one here. And we're not going to look at indicators at this moment. We're just going to be talking about the flag formation and how to actually notify or look at a projected target where it's likely to go if it breaks out. So as an example, what we have here right now is we have a flag. What we have here is a flag formation. Okay, so we have the flag formation from here. The market runs up through here, and then the market runs down through here. Okay, through there. So it looks like it's a flag formation, as you can see. Okay, right. So big run up through there, and then we've had some big run down through there. So it's a big flag formation. It runs up and slowly steps down, and it broke to the high side. Okay, broke up to the high side. So if it breaks to the high side, if a market breaks out of its flag, then what I'm going to show you in this quick little session today is how to actually see where is it likely to go to for a conservative target, but also for more of an aggressive target. Okay, sometimes the aggressive target actually is much better to actually try to go for because it gives you a much better risk to reward ratio, much better on the reward, and your risk is much smaller. Let me show you here. So when we have a flag formation, okay, when we have a flag formation, the market runs up through here and it slowly steps down through here. When it slowly steps down, when it breaks out, where's it likely to run to? The first area it's likely to run to, which has a high probability, is the latest peak. So the market runs down and pops out. If the market does break out, it's likely to run to the latest peak, which it did through here. Now in this case, eBay popped up and just went through there. Okay. So that was the first target. Now the second target is a projected line. Now what I mean by that is this. You can see this line through here. Now what I've done through here is I've just carried it up through there, okay, and I've just projected this down through here. Let me just project that down through there. So I'm going to basically delete that. All I'm doing is taking it from the lows of this sort of point through here to the high of that point. And then all I'm going to do is I'm going to grab that exact same channel. I'm going to create a parallel trend line. So you can see it's the exact same line. And I'm going to bring this out, and what I'm looking for now is I'm looking to see where did this break out. Okay, where did this break out? And so as you can see down the bottom here, right here, that was the low point of where the market broke out. Make sense? So the market, this was the low point in the flag. So the market ran up, came back down, and it broke out. So now we're looking for an overall target projective of where this market is likely to run to. Okay, where this market is likely to run to if it does pick up some steam. And so what we do is we grab this exact same length of the pole from the almost low of the point to the high of the point, and then we grab that exact same length, the exact same line, and all we're going to do is we're going to extend it at the bottom. Okay, we're going to put it at the bottom of the open of the very low. Okay, you can put it down the bottom if you want here, so basically down here. Okay, so they're basically almost the bottom. So we're looking at the lowest point before the breakout. This was the lowest point right here. Okay, so this was the lowest point right here. So that's where you actually put the low and you extend it out. And where's the market likely to run to? The market's likely to get up to the top here. I had a target projective up the top here, and as you can see, the market ran right up to there, and it popped and it ran up through here. It actually stopped there, and now it's actually reversed just a little bit on eBay. So the reason why that's important is this, is that if you can actually get in, as an example, let me show you here. If you can actually get in, say here, and your stop is down here. Let's just say there, okay? Your stop is down there. So let's say you get in at $51 and your stop is $49. That's a $2 risk, okay? But you say, you know what? I'm going for a bigger target on this one, which is going to help you, if it does reach it, give you a better risk to reward ratio on your trade. And so you get in at 51, so as an example, and now your target is say up here at say 56. Okay, so we're looking at, what's that, 1 2 3 4 5, a $6 target to a $2 risk. Okay, so even if you're absolutely shocking at trading and you had a 50-50 win-loss ratio, okay, which you're likely to get probably a lot better traded these patterns here, a 50-50 win-loss ratio with, as an example, with this risk-reward ratio where you're looking for a $6 target move on the stock for your reward, but then your risk over here is $2 as an example, or even just $2.50 as an example. This is so much greater. Now, here's the best thing about this, is that if you're using options, then your option, as an example, okay, depending on option you use, your risk could be anywhere from say 40%, as an example, up to say 60-70%. Again, as an example, all right, depending on option you pick. But if the market does go up and does explode here, then your reward could be as much as 80%. Okay, 80%, up to, you know, say over 100% return, as an example, right? Again, we're looking at as an example. Now, depending on option you pick, that could be the case. Okay, so what if we're getting at this one here, and the market drops down through here, then your risk could be anywhere between 40-70%, and the reward could be anywhere from 80 to 100%. Now, it's probably a lot different, again, depending on what option you pick. If you pick an in-the-money option, which I'm not going to go into detail, simply means below the price. So we look at, say, a call option, and if we looked at a call option, and we say it's $51, and we looked at, say, a $50 option, if we bought a $50 option and the market dropped down through to, say, to here, then, you know, we might be looking at maybe a 20, depending on the speed of it, 20 to maybe 30% loss, okay, as an example. So if you bought the $50 option, we're likely at a 20 to 30% loss because we've got that buffer, okay, as an example. But if the market went from 51 up to now this one here, now you're looking at probably about 100% return. Again, there's no guarantees in this one here because you could lose. 100% return plus, okay. This whole risk to reward here, what we have here, this risk here, and this reward here. This is the reason why I personally trade options around stocks and not just directly stocks. Stocks are generally a one to reward, one risk, okay? But options, if you know how to trade them right and use the right ones, they can definitely give you a very, very good risk to reward ratio. As in, you can see, this is the risk as an example, and this is your reward here. So anyway, I hope you've enjoyed this video. This is about flags, this is about projective, and use these tools, use these things. And at the end of the day, even if you're an absolute shocking trader and all you did is wait for patterns like the flag formation and you had a 2, 3, 4 to 1 risk reward ratio, meaning you're looking for a $6 target projective, even if you're just trading a stock and you've got a $2.50 risk, and you did it every single time, and you traded high quality patterns, an example of the flag, then you're going to do well in the markets, okay? Now, again, I'm not saying you're going to do well, okay? But if you stick to a really good trading plan, you have stops in the markets, okay? Even if you're an absolute shocking trader and you stick to really good quality stocks and you're doing everything right, you now have a very, very good chance of actually doing well in the markets, okay? Because the odds are now on your side. So if you are struggling with the markets, then bring it back to basics. Bring it back to where you can now start moving forward on a regular basis and stop putting the, I'm trying to get an 80% win-loss ratio. Because maybe it's not the 80% win-loss ratio which is going to make you money. Maybe at the end of the day, it's your risk management. It's your trade management. It's your money management which is actually now killing you. Your risk management is simply what is your risk reward ratio? In this example, this is a good one. We have a $6 profit target for $2.50 risk. Great trade, good risk management. Trade management is, where do you enter the trade? Do you enter the trade down here or do you enter the trade up here? Bad trade management. Okay, good trade management is down here before the breakout. Wait for the breakout. Good money management. What is good money management? Good money management is trading no more than 5% of your account on any given one trade. No more than 5% of your account in any given one trade. Okay. Now that means maximum of your account is at risk with 5%. Now, if you're leveraged, then try to cut that down to at least a couple % of your account at any one time. Okay. Leverage is going to kill you if you don't know what to do with it. Leverage is a great thing, such as options, but if you don't know what you're doing, it can absolutely destroy you. So make sure that you've got good risk management, good trade management, and good money management to help you with this. So even if you're doing really, really bad in the markets, bring it back to basics and have a look at this on a bigger, broader view, and this is really going to help you moving forward. So this is John Howe from tradinginvestingforyou.com. I hope you've enjoyed this. We actually put videos like this all the time on our Facebook, which is facebook.com/share trading mastery. Check us out on our Twitter, which is twitter.com/John Trader. And make sure you click on the subscribe button, and make sure you leave a comment below as well too. Let me know what you thought about this video. That's it for me, guys. This is John Howell here from tradinginvestingforyou.com. See you in the next video. No matter what happens, say this yourselves every morning, every afternoon, evening, and that is success can be yours if you go claim it. So step up, take massive action, and face your fears today.